or the housing crash or the the recession we had in 2000. And there's basically, at this point, even 15 years later, there's basically two categories of loans. And I want to talk about both of these because both are important depending on your situation. The first one is called a QM mortgage, and this was again developed after the recession in 09, 10, and they changed some guidelines for Fannie Mae on what their expectations were around products, our clients, and qualifying, underwriting, etc. QM stands for qualified mortgage, and we won't go into details around that so much, but there's four general loan types that fit into the QM category. There's going to be conventional financing. There's going to be FHA, VA, and USDA. Those are the four traditional types of loans that have been around for decades. Ever since 1985, I've been providing loans in those categories depending on the client's qualifications and preference. And then the second category is called non-QM, anything outside of those guidelines for what we call the agency type loans. So we're going to explore those first because those are the most popular in the sense that probably 80% of all mortgages flow through the QM channels into what Fannie Mae purchases and Freddie Mac and whatnot. And so, but I do want to kind of cover the pros and cons on why we help people with different types of loans. And the number one, at least in Austin for the last several years, has been conventional financing. Now, after the crash in 08, 09, 10, most of our loans at the time were done by FHA because conventional financing was so hard to qualify for back then. But as the market's improved over the years, conventional financing has been the predominant type of loan that we've been doing. And again, these guidelines are set forth by Fannie Mae and Freddie Mac, who they're the rule makers. They have the gold. And so the pros around that are typically that your interest rates are going to be very competitive. And right now, they've just raised the loan limit to $750,000, which you could still do loans in the conforming conventional markets up to $750,000. Now, to put that in perspective, when I got in the business, it was $133,000. Keep going. So back in 85, 86, if you borrowed more than $133,000, then you would have to go into what they call the jumbo market. So as prices have increased over the years, Fannie Mae has typically annually makes changes to their loan limits. Right now in Austin, Texas, it's $750,000, or Texas in general. And so that's called the conforming loan limit. Now, the downside of debt products sometimes, or when it happens, is credit scores. They're very, very strict, if you will, on what they'll allow for your credit score. They won't go under 620 for sure. 780 on your FICO model will give you the best rates and the best MI rates. And they categorically change that as you go down at lower credit scores. So MI can get very expensive if your scores are under, let's say, 680 and you're putting down 5%. Now, they do have a very popular 3% down product called a Home Ready, which is very good for first-time buyers and people who qualify within certain income limits. So conventional markets in Austin, for sure, the last several years has been the primary loan type but in the other downside, it's a little hard to qualify for. Their debt to income ratios are tighter. So again, if you need some leeway on debt to income, FHA is usually the product that people are going to tend to, or VA if you're qualified veteran. We're going to talk about that in just a second. And so conventional is a loan type that's, what we're doing most of with either 3, 5, 10% down, et cetera, et cetera. So the second type of loan product that's been around forever, since really the 30s, is FHA. FHA stands for Federal Housing Administration. And again, it's been government backed for literally decades. And we've been providing FHA loans for a long time. So in 2008, when the market was kind of shifting in a big way, I decided to become a provider and instructor to the Real Estate Commission. I was the first provider in the mortgage space to become approved by TREC. And because I thought, with all the crisis and all the changes that realtors really needed to know what's going on. So I created my first course I ever taught. I created to teach was called FHA is the Way, because back in those days, FHA fundamentally didn't really change their guidelines. They tightened up some, but not like conventional. So most people, because of credit scores and other challenges back in those days, FHA was the primary product we were doing. Probably 80% of our loans in 2009, 2010, 2011 were probably FHA, because the subprime business had all gone away, and Fannie Mae had made some serious changes to their guidelines of underwriting back in those days. So FHA, the advantage of the program even today really is it's designed typically for first-time buyers, but you don't have to be a first-time buyer to qualify. They give you a lot of flexibility on your down payment. The minimum down payment is 3.5%. It's very popular with the state programs as far as down payment assistance, MCC programs. So again, it's sort of designed for first-time buyers. My very first home I bought in 1990, I went with an FHA loan at the time because I didn't have a lot of cash, and I needed a little bit more easier loan to qualify for. I haven't done that in years, but that's the way we were doing it back then. And even today, what we're starting to see in this market is a lot of people coming in for the first time as first-time buyers. They're renting apartments or they're renting houses, and they're saying, hey, I want to own my own place. Now, again, a lot of those folks are qualified. I wrote a loan this week for the young couple, and it's the very first home. They were able to put down 20%, great credit, so they went conventional. There's no reason to go FHA, because the downside of FHA is the mortgage insurance, what they call the MIP, mortgage insurance premium. And regardless if you put down 20%, you're still going to have to pay the what they call MIP, which can get kind of expensive, although they have recently reduced the monthly from 0.85% of the loan down to 0.5%. So it's cheaper than it was, last year as far as the MI goes. But they also charge a fairly hefty upfront mortgage insurance premium that you're going to have to pay on top of that, which you can usually roll into the loan amount. But it just gets a little more expensive from that perspective, although their interest rates are very competitive. I've got a client closing in December next month. And he was able to put down 20%, but his credit scores were kind of low and his debt to income was high. So we had to go FHA, even though he's putting down that kind of money. He had to in order to keep his payment in a budget range for he and his wife. So FHA is starting to come back more in favor. But again, the downside is you cannot get rid of that MI or that MIP, I should say, that monthly MIP, like you can conventional. That's one of the advantages of conventional financing when it comes to MI. I live in a home now that my wife and I bought a few years ago, about a year and a half ago, and we put down 10%. So we are paying a monthly PMI. It's about $70, $75 a month, something like that. Now, come May, after the first 2 years, I can appeal that to the servicing company and have them remove it, because I have the equity now in the property that I don't have to pay that anymore. So after a couple of years, they do require it, but after that, you can appeal it through an appraisal and other means to get rid of that. In my case, $75 a month. With FHA, if I had an FHA loan, I couldn't do that. So that's the downside of FHA. I'm trying to think, but they're also very flexible on gifts. It's easy to, they'll allow gifts from parents. And again, down payment programs. So a lot of our first-time buyers who don't have a lot of cash will go through what we call the DPA programs through the state. And again, the other program which I talk about frequently, at least on some of my reels, is the MCC program, Mortgage Credit Certificate. Now, MCC is a product that's not a loan product per se, but it is benefit program for first-time buyers within certain categories of income that the government will step in and subsidize your mortgage payment essentially by giving you 20% credit toward any interest you pay on your mortgage. So that's a very good benefit. It didn't just have to go with FHA, but that seems to be the most popular one because I do have income limits on that. The other benefit of FHA is they'll allow for a co-signer, like a parent, to come in and co-sign a loan for a relative, let's say a son or a daughter who wants to buy a property, and they can't qualify on their own. The parent can step in and co-sign that loan and still just put down the 3.5%. And sometimes that plays out in, let's say, a duplex. Normally in conventional financing, you get to put down a little bit more money, but FHA, if you buy a duplex, will still allow you to go 3.5% down, which is also another benefit for that. Now, the loan product that's probably the best if you qualify is going to be a VA loan. And VA loans were established back in the 40s after World War II for the returning veterans after the war to help them buy properties. And the guidelines have been at least the zero down has been part of that program, for 60 years. And we still do a lot of VA financing. VA in Texas. Texas has the second most veterans in this state compared to California. California is number one. Texas is number two. So Texas is a very large population of veterans. And again, a lot of them don't know what kind of benefit they have through the VA on different levels. But housing is something we specialize in there. And if you qualify as a veteran, I've never seen where a veteran it is not the best product for them. In other words, if you look at a VA loan versus an FHA versus conventional for a veteran, VA always wins. And the reason is typically zero down. They can very, very, very competitive interest rates. Back in the old days, they weren't very competitive, but that shifted years ago. The other thing that shifted years ago was the fact that the closing costs used to have to be paid by the seller. Those days are over. So everything's negotiable on VA. Now, sellers still pay a lot of fees or closing costs for veterans, but again, it's not contractual. So a lot of sellers now will look at VA contracts that they may not have looked at, back in those days. Secondly, they don't have a monthly fee for mortgage insurance, what they call a funding fee. They do have a funding fee, which is rolled into the loan amount. So if you buy a $400,000 house and the funding fee is, let's say, $8,000 or whatever the calculation would be, you can roll that onto the loan and still go zero down. Now, there are closing costs involved in that and prepaids for tax and insurance. But again, a lot of those expenses will be either paid by the builder if you're buying a brand new property, or by the seller. So, if in fact you have a disability, at least 10% disability through the VA, then they're going to waive any funding fee. So it's very, very attractive for veterans to look at that option. And the other part of that, in FHA included, one of the benefits, and we're starting to see this more and more, I'm getting calls from clients and realtors, is that VA loans and FHA loans are what they call qualifying assumptions. So if you're looking to buy a property now, and interest rates, let's say 7% or 7.5%, wherever we are, and you can find properties for sale that they financed a few years ago at 3%, 3.5%, 2 3/4, whatever, you can actually go in and assume those loans. And I've done some talks on that too, but I want to remind people that could be an option for you. It's not always an option. It's a very negotiable thing between you and the seller. But again, that may be an option if you're looking to hopefully pick up some cheaper money. VA and FHA loans are assumable. Then the fourth category is in what they call the QM world is USDA. USDA, again, during the 2009, 2010, 11, was a very popular program as well, because it allowed certain pockets of the city, let's say Kyle or Manor, even parts of Round Rock and Pflugerville at the time, to go zero down using conventional financing. You didn't have to be a veteran. It was a conventional loan. It still exists. I just closed one up in Bell County the last month. It's not as popular as it was, mainly because it's very hard to qualify for. They're what they call DTI, or debt to income, is 41%. They'll give you a little leeway on that, but not a lot. So if you have significant debt, then you won't be able to qualify for the USDA, mainly because it is a zero down loan. But they do have very, very low, what we call mortgage insurance. So it's a great product if you can qualify for it. It does have some income limits and geographical limits. That's why most of the Austin area doesn't qualify anymore like it used to, because of the growth of the city in the last 10 to 15 years. A lot of the pockets that we used to do loans in, let's say Kyle's example, we did a lot of USDA loans in Kyle. that area is not qualified anymore. So normally you have to go north. In my case, my client bought in Bell County, somewhere around the Belton area. So again, if you're looking to move outside of Austin and you qualify with income and debt to income and credit, they do have fairly conservative credit guidelines as well. That may be the way to go. It's certainly worth looking at. Now, I did have a loan, another client who was looking in the Temple area. We started with USDA, but he didn't qualify because of DTI. So we had to flip it over to an FHA loan and go through the state for his down payment assistance, because he didn't have a lot of money to put into it. So we were able to close it, but his rate was going to be higher because we had to go with DPA. And those DPA programs, those rates are usually priced higher than you can get in the marketplace. So it wasn't ideal for him, but that was what we explored, and that was the best we could find for him. He couldn't go conventional because his credit scores were too low and he didn't have a lot of cash. So those are kind of the four categories of what we call not conforming, but qualified mortgages. And most of our business is in that world. That's what we do. So we always look at the person's client's ability to qualify based on the guidelines that are given by Fannie, FHA, VA, or in this case, sometimes USDA. So we always start with that, number one, because the more you can qualify for as far as documentation of income, credit, etc., the better deal you're going to get. Now, that speaks to moving into the other category of loans called non-QM. A non-QM loan simply does not fit in the box over here. And we use those loans typically for investors who are looking to pick up properties. The other downside of a conventional financing, it only allows for 10 properties for an investor in the Fannie Mae world, the Fannie Mae box. So if you have an investor who has lots of properties, they would have to go into the non-QM space to get a mortgage. You can still do it, but it's typically going to be where the rates are a little bit higher. But they also have different guidelines on qualifying. Like I'm closing a loan now this is not an investor. This is owner occupied. The young man's getting divorced and they're selling their home. He's going to receive quite a bit of cash, and he has a small business. He doesn't he doesn't claim a lot of income, but he makes decent money, and we can show that through his bank statements of his business. So a non-QM loan is such that he's putting down, in this case, he's putting down about 40%, large down payment. He doesn't want a big mortgage, but he wants a property that's going to cost around $450. So he's putting down around, I think around $200, $250. And we're doing what they call a bank statement loan, where he cannot qualify because his wife will no longer be on the mortgage with him. He has to qualify by himself, but in his business, he writes off most everything and doesn't claim a lot of income. But through the bank statements, we can show that he has cash flow. So the lenders will give you a percentage of that cash flow through your bank statements to qualify you. Now, the rates are closer to 9%, 8.5% to 9% versus today's market around 7%. So you're paying an additional couple points of interest, at least temporarily. Now, next year, and I told him, I said, look, if you change your tax filings and you're making more money, we may be able to refinance you down the road in using a conventional type of loan. But in the meantime, this is the way we're going to do it. And he thought that was fine for now because he didn't want to rent. He's been a homeowner for several years. So that would be an example of a non-QM. Another non-QM type of loan would be a DSCR loan, which stands for where an investor wants to buy a rental property, but again, because of whatever circumstances they're in, they can't qualify through Fannie Mae. So what the lenders will do there is they look at the rent proposal on the property that they're buying for their investment property. And if that rent covers the mortgage, let's say it's a $3,000 a month rent, proposed rent on this property, and their mortgage payments around $3,000 with the new loan, then they'll make that loan regardless of tax returns and all that sort of thing. They do want to see better credit. So credit scores again are a big factor because people are saying, well, we're going to take a risk. Lenders are saying we're going to take a risk on the income side. We want to make sure that traditionally they've paid their bills on time. So you can't have bad credit if you're looking to do what we call a non-QM loan. There's even one bank out of New York. I'm not sure this product is still around. I'm going to double check on that for a client. But they'll do what they call a total non-qualifying loan. You put down 20%. You have credit scores over 700. They don't ask for anything. They don't ask for bank statements. Well, they do ask for bank statements to prove the down payment, but they don't look for cash flow. They don't look for tax returns. They don't look for anything. But again, that rate's going to be closer to 10%. So everybody's situation is a little bit different. The other part of that would be, again, in the non-QM world, would be jumbo financing. Now, jumbo financing is not high risk, typically loans. Those are loan amounts over 750. So typically people who have a lot of income who could qualify for a larger loan than the 750, let's say $1 million. Now that's called the jumbo. Anything over the 750 loan amount is considered a jumbo loan. And that again is purchased by the secondary market in a different category, if you will, than conforming loans. And usually the banks, the bigger banks, the big commercial banks like Wells Fargo or First United or Bank of America, they like those larger loans because typically those people have more money and they want the deposits as well as the mortgage. So they'll sometimes work with clients on getting their mortgage if they're willing to put up some money as a CD or something like that. And the guidelines are going to be tighter. So typically as a mortgage broker, we don't do that many jumbo loans because depending on the situation, sometimes the banks are a better offer. And I'll tell people that. I say, you may want to check with your bank if you're borrowing $1 million, $1.2 million, because a lot of times they may have a better deal than I can provide. I usually have a better deal under the 750, the FHA, and the QM world. And so those are just some ideas that you may want to consider if you're looking to purchase a home next year. Make sure that you get your ducks in a row and kind of understand the basic guidelines. And then we can work through what it may appeal to you as far as getting a house and making sure you fit into your budget. I always tell people, don't go house shopping without getting pre-qualified first, because you may get disappointed. That you're if you like a $500,000 property, but the payment's $4,000 a month, that may be out of your comfort zone. So again, get pre-approved. We can do that for you fairly quickly. Let's see what else we might. Yeah, there's been some recent changes too, and I don't have specific guidelines around this, but Fannie Mae did come in and lower the down payment requirements for owner-occupied when I say multifamily, I mean duplex, triplex, or fourplex. So in the old days, to buy a fourplex, even if you're going to live there, you had to put down 30%, which is a lot of money for most people, because fourplexes in Austin may run, $800,000. They're not cheap. But again, you have rental income that could offset that mortgage payment, and they've been made some recent changes on down payment for owner-occupied properties, and also second homes. A second home is defined. There's three categories. There's a owner-occupied, that you're going to live there. You declare that you're going to live there. There's investment properties, which you declare that you're not going to live there, that you're buying strictly as a rental property. And the second home is defined as a property that you're going to use for vacation. Could be down the coast. It could be at the lake. So the second home properties are also available to people, but you're not, you can Airbnb them, but you can't put a long-term lease on them. I did a loan for a friend of mine, actually, at Horseshoe Bay. He bought a condo in Horseshoe Bay that he's going to use quite often, but in the meantime, he's going to also Airbnb it. So it's considered a second home because he's going to use it most of the year, or several weeks a year for sure. Otherwise, he's going to use it to Airbnb to offset that mortgage payment. That's different than if you're buying a rental property where you're going to have a signed lease on it, et cetera, et cetera. And speaking of that, one of the benefits of conventional financing is that if you are moving from a property that you want to keep as a rental, and you can have a lease put on that before you close on the new house that you're buying, then we could offset that current mortgage by that lease and help you qualify. You won't count that against you as far as the DTI. So that's another tool that a lot of people are using now, because they see, that real estate prices should be going back up here in the next year or so, and they want to keep a long-term investment. And the rental market seems to be still pretty hot. So that's something to keep in mind on conventional financing. And so I thought we'd just kind of leave that with you guys today. If you have any questions, give me a call back or call me at 512-789-6967. We will take a look at your situation and make sure we find the best product for you and your family. Until next week, happy trails.